Hello class, this is Dr. Fenton. In this video, we will cover Chapter 6 that discusses relevant information for special decisions. So let's get started. Now on this page we have a lot of definitions, and we'll need to understand these definitions here because they do relate to information coming up on future pages. First of all, what about relevant information? Well, this information is information that differs between alternatives and it is future oriented, for example. So if you're deciding to buy one item over the other and there's a difference in cost, well, that's a relevant bit of information. The cost differs and it's a future decision. Let's drop down and look at sunk cost. Sunk cost is an historical cost. It's already been paid for, and any future difference should have no bearing on that previous sunk cost. So sunk cost will be irrelevant. It happened in the past. We cannot go back and change it, so it doesn't make any difference. For example, let's say you purchased a car. Let's say you paid $30,000 for a car. You keep it 6 months, and then you want to sell it for some reason. If someone offers you $22,000 for it, another person offers you, $20,000 for it, you're thinking, well, I don't want to sell the car because I might lose money. I paid 30 and I'm only getting offered, 22 or 20. Well, your cost you paid for it does not make a difference. It's a sunk cost. So I know it feels like it needs to be, in the equation, but if the market value now has dropped that much in 6 months, then what you paid for it does not make any difference to your decision. You're either going to get $22,000 for it or $20,000 for it. Or you can keep it if you want to. But the $30,000 amount that you paid for it is a past cost. You cannot go back and change it, so it does not make a difference in your decision. Opportunity cost. Here they have an example for us. Let's say you have another car, and you could sell it for $19,000, or someone else offers you $18,000 for this car. An opportunity cost is the next best alternative that you're giving up when you go with the decision that you made. So if someone offers you 19, someone else offers you 18, you'll take the $19,000. Your opportunity cost is $18,000. It's not recorded anywhere. It is not money going out the door. It's what you gave up. You gave up $18,000 to receive $19,000. So that's an opportunity cost. We get into relevant cost. Again, going back to relevant information, is it a cost that makes a difference in a future decision? The example they have here, we're going to bring it up slightly, is you have a bakery, and they're thinking about adding a line of cakes or a line of pies. So to make one cake, you can see here, the materials will cost $1.50. To make one pie, the materials will cost $2. This is a relevant cost. It makes a difference in a decision, and it is a future decision coming up. Should I make cakes or should I make pies? Or you don't have to make either one, but the materials is a relevant cost. Now direct labor, look at this. It'll cost you $1 in direct labor to make a cake. It'll also cost you $1 in direct labor to make a pie. This is not a relevant cost. So deciding on whether to make cakes or make pies, this amount is irrelevant. Yes, it's a cost you're going to incur. You're going to record it. But with the decision on hand, this cost is irrelevant. Just like the supervisor's salary. With either decision, you're going to pay $25,000 for the supervisor. This is a cost. Again, it will be cash going out the door in the future. But deciding in between cakes and pies, it doesn't make a difference. It's the same under either alternative. Now the cost of cakes, there's a franchise fee that'll cost $50,000. You don't see the franchise fee over here, and so that is a relevant cost. Pies, you might advertise for pies. You may be, whatever franchise you're joining, they'll do the advertising for you. But here, if you make pies, you might do your own advertising. It'll cost you $40,000. You don't have a separate line over here for advertising, so that is a relevant cost as well. So you look and see which ones are different between alternatives. Okay, and that will be the relevant cost. And let's see, you can read some of this yourself. You don't have to be exactly precise for your information to be relevant. Of course, it's most useful if it's as precise as possible and relevant, but it doesn't have to be totally accurate. And then you have quantitative characteristics. Of course, that deals with numbers. Qualitative deals with non-number kind of situations. Avoidable cost is a cost you can eliminate if you eliminate a certain, let's say, product line. So in this example they're talking about here, they're trying to decide, should we eliminate the children's line of clothing? Well, if you do, you will lose that revenue. And let me bump it up just a little bit right here. There we go. That is differential revenue. So if you get rid of a certain line in your business, a product line, you will lose the revenue. That is differential revenue. But you also would save cost. And so the cost you would not have to pay for if you get rid of a segment of your business, those will be, as they say here, avoidable cost. Now, if you remember in the previous course, they talked about these different levels of cost. So it talks about the unit level, and we talked about that briefly in the last chapter. But this would be a cost that will increase as you produce more units. And of course, if you decrease, it will decrease if you produce fewer units. That's a unit level cost. A batch level cost will be the cost you incur to get ready to make a whole batch of units. And an entire batch of units could be like 1,000 units, 1,000,000 units, whatever. You're going to have a run of that so that you can set the batch up, make a run of those units, and then you'll use the machines for a different product. So you have a batch level cost to then get the machines ready for the new product. So batch level, it can be like the setup cost we talked about earlier in the previous chapter. Product level cost, this has nothing to do with the actual production itself. This is, as it says here, inspection cost, engineering cost, cost obtaining, defending patents, and so forth. So just to be able to produce that product, you're going to have product level cost, and you'll incur a lot of these before you even start producing that item. Facility level cost, they support the entire company. They can be building rent, depreciation, personnel administration and training, property, real estate taxes, and these are costs you incur just because you have the facility. They don't relate specifically to one product or one unit, but they relate to the company in general. Okay, so that's it. Let's go to the next page. This just shows 5 types of special decisions we're going to talk about in the upcoming pages. The first one, special order. Second one, outsourcing. The third one, segment elimination. Just sort of talked about that. The fourth one, replacing an asset. And the fifth one, scarce resource allocation. Let's go to the next page. Here we have a discussion about special order decisions. Let's look at this example. We have a company that makes printers. Let me bring this down a little bit. Here we go. And let's look at the numbers. Currently, Premier is the name of this company. Premier expects to make and sell 2,000 printers. Let's look and see how much the printers cost to make. So to make 2,000 printers, the unit level costs are down here. Materials, labor, overhead, and there's the total. You see 2,000 units times the cost per unit. We have batch level cost, and they do this in a series of 10 batches. So we multiply the batch level cost out here. So here's the batch level cost, 22,000. Product level cost, just to have this particular product, engineering, product manager salary, 77.3, and facility level cost, we have a division manager and some administrative costs. Other overhead costs allocated here, you can see these. So our total facility level cost, $199.2. So to make 2,000 printers, the expected cost is $658,500. Divide that by 2,000, and so it's costing us $329.25 to make these printers, per unit. So quite a few costs going on here. So it's not just materials, labor, and overhead, but you're going to have batch level cost, product level cost, and facility level cost that you have to consider when you're making your product. And it looks like what they do, they add their normal markup, and so they sell the printer for $360. To me, that's not much of a markup, but maybe that's what the market bears. Okay, so at least we have some markup, and we'll have a positive gross margin for this. Now, a new customer contacts Premier and says, I will buy 200 printers from you, but I only want to pay $250 per printer. Well, look, the regular selling price is $360. To make those 2,000 printers they are already making and selling, it costs $329 each. But this new customer says, I'll pay you $250. Well, at first glance, it looks like, no, there's no way you're going to do this. If this cost me $329, I cannot sell it for $250. I'd be losing money. Well, we need to look at what is relevant for this particular decision. For this decision only, to make 200 printers, could you possibly sell the printers, these printers, for $250 and still make a profit, at least a gross margin? Now, there are other things to consider on special orders. You might have this customer and they want to put their name on this printer or something, and so it would not be identified as your printer, because you would not want your current customers to be upset about this. So let's see what we have here. Let's come on down. What are the steps you need to consider on this special order decision? First of all, look at the relevant or differential revenue. What's the alternative? If you don't accept the special order, your revenue is zero. If you accept the special order, your revenue will be $250 each times 200 units, $50,000. So since we have a difference in revenue, zero compared to 50,000, this is relevant. So this is a relevant revenue. What about the cost? Which cost will actually increase? Which ones will be relevant to this decision? Only to this decision, which cost will be relevant? You got to think of it that way. They tell us to look at Exhibit 6.1. A lot of cost in here, but which one of these are actually relevant? Unit level? Yes. Batch level? Maybe. We'll take a look at that in a minute. Product level? Probably not. Facility level? No. You already incur in these costs, and making 200 more printers will not increase these. The only increase would probably be for a batch here. You got to set it up and make this special run for 200 computers, and then you would have these costs, unit level costs. Let's go back down, and where are we? So the unit level and batch level cost are relevant, and it says here they'll have one additional 200 unit batch. So we will have one set of batch level cost, and we'll have 200 units you're making, so the unit level cost will also go up. All right, so now let's see if we should accept or reject this offer. Our differential revenue is $50,000. $250 each on the special price times 200 units. And they call this differential revenue, which is fine. You could call it differential or relevant revenue. They say avoidable unit level cost. I would rather use the term differential or relevant unit level cost. It means sort of the same thing. You can avoid this cost if you don't make it. If you make it, you have to pay for this cost. So here we have 180 times 200. Batch level, we have 2,200 times one batch. Let's go back to the top and see where we get these numbers. Here we go. Here's the 180 for materials, labor, and overhead we will incur to make these special units. And to set up one more batch, it is 2,200 per batch, and we're going to have one batch being made. So that's where we get 200 times 180, and then we get 1 times 2,200. Here we go. There are the numbers. these are the only costs you would incur to make this special order. If your revenue is 50, and here are your relevant costs, your contribution to income, in other words, your gross margin on the special order is $11,800. So your income, your net income would go up $11,800. At first, it did not look like it because we were selling it far below our regular selling price. The $250 special order selling price looked like it would not even cover our unit cost to make. But when you get down to what is relevant, then it looks like we should make this special order. Let's add one more thing to this, opportunity cost. Let's say that instead of making 200 more units, you could rent out your excess capacity, and it looks like you could rent it for, $15,000. You have excess capacity, and you could get $15,000 for that. Okay, so if you add this opportunity cost to this special order decision, then you'd find out you're going to lose money. How's that happen? Well, remember, we had $38,200 in these unit level and batch level cost. To make this, you're going to have to give up another $15,000. That's costing you money. And so if you add the $15,000 to the $38,200, your total cost then will be $53,200. You're only receiving $50 on the special order. You would lose $3,200. So when you look at this, you're better off rejecting the special order and leasing the excess capacity by and getting the $15,000. So you can see, special order, your income would increase $11,800. If you lease it, your income would increase $15,000. So there's the difference, and so you should lease the excess capacity and not make the special order. Now the managers in the company start thinking, well, if I can make money selling the computers on the special order at only $250 per unit instead of $360, can I sell all my units for $250? In other words, everything you were making plus the special order, could you sell all of them for $250? Well, your revenue would be $550,000. Your unit level cost would be $180 times $2,200. Batch level, we have 11 batches now times $2,200. But you will still have your production level and facility level cost. These don't change. Go back up to the top, exhibit 6.1. All this total will still be here. Add all these costs up now, and you can see if you dropped the price for all the units, the entire amount you produce, you will lose money. In fact, you will lose $146,700. So you don't want to do that. You don't want to drop your prices for everything. Okay. And you get into qualitative characteristics. I'll let you read about this, about accepting or rejecting special orders and so forth. All right, let's go to the next page. Now let's look at an outsourcing decision. This is where you're making a product, and then you start looking around, and maybe you can find someone else to make their product cheaper than you can. You give them the specs, and they should be able to make it to the quality standards you want. But could someone else make it cheaper than you're making it? Let's look at the numbers. We have an offer here from a supplier and says, you know what? We will build these computers for you for $240 each. And first you think, well, if I can buy them already made for $240 and they're costing me $329.25 to make, then surely I should go ahead and not produce them myself and outsource this to someone else. Is that the right decision? Again, you need to divide these costs up into what costs are relevant and which ones are not relevant. In other words, and also, cost. We're not dealing with revenues here. You're still going to sell 2,000 computers or printers. But which cost will change if you make this decision? Which cost will not change? So let's look at this. Now, surely you know that if you don't make the printers yourself, you can avoid all the unit level cost and all the batch level cost. And they also figured out that, well, we don't have to worry about the product level cost either. The engineering design, product manager salary, production manager salary. So you can save those 3 areas in cost: unit level, batch level, and the product level. So do the numbers still work out though? Let's look at this. If we look at the unit level cost, 180 we saw earlier times 2,000, there's the cost. Here are the batch level cost, product level cost. So if we have someone else make the product, we can save $459,300. So that's what it's really costing us in relevant cost, not total cost when you pick up the facility level cost. But for relevant cost for this decision right now, here is how much it's costing you. To make it, it's costing you $229.65. Well, they offered to sell it to you for $240. You would say, no, I'll continue making it myself. Okay? Because they already work out the numbers here. If you decided to go ahead and buy from the other from the supplier and paid $240 for 2,000 units, excuse me, you would have profit that would decline by $20,700. Okay, it only cost you this in relevant cost to make. You have to pay this amount to buy it, and you see that, well, this is multiplied out, but when you do it, you'll see that you're going to lose $20,700 if you outsource it with these numbers right here. Let's take it one step further. Let's throw in opportunity cost again. So then you realize that, wait, if I let someone else make the printers and sell them to me, I have all this excess capacity, excess space. I can rent this out for, they say, $40,000. Someone else wants to use it. This is $40,000 you could be receiving. This is an opportunity cost that needs to go into this decision. So if you take your original relevant cost here, $459,300, add the opportunity cost you're giving up if you make it yourself, it's now costing you $499,300 to produce, relevant cost-wise plus opportunity cost. Then the new unit cost, you put all this together, if you make it yourself, is $249.65. That's more than you can buy them for. So this would tip the scale in the other direction. You'd be better off buying the printers and leasing the manufacturing space. So notice the steps here. Here we're looking for relevant cost. Which ones differ? When we stop there, we should make the product ourselves. But if we're giving up something else, you need to factor that into the equation. And so here you'd be better off having someone else make the product, because you can now take your excess capacity you'll have and rent that out to someone else. Now let's see if the numbers change. If we think, you know what, I think next year our units for sales will go up to 3,000, therefore we should make 3,000 units and sell 3,000. If that's the case, even if we have the opportunity cost of $40,000, should we make this ourselves or have someone else, in other words, outsource it? Here, the decision of outsourcing, because we had this opportunity cost that now becomes relevant. Well, here, if we make 3,000 units, here's the total cost, batch level cost. We now have 15 batches. Product level cost, stay the same. Opportunity cost, still there. Our cost is $690,300, but we're making 3,000 units. So the cost drops to $230.10. Almost $10 below the outside supplier's cost. So if you can ramp up scale and can sell the products, what happens, your fixed cost gets spread over more units, and therefore it drives down your unit cost. So here again, you should make it yourself. This is some interesting reading here about qualitative features. It talks about vertical integration, lowball pricing, certified suppliers. So make sure you read through this yourself. Let's go to the next page. Now we have a segment elimination decision to make. Let's go back to Premier Office Products again. They were making their printers earlier. And now we look and see, they're not just making printers, they're making computers and copiers. So here's the entire projected income statement by segment. These are the 3 segments they have. So you have, the revenue for each segment and the total, unit level cost, batch level cost, product level cost, and facility level cost. Come all the way to the bottom and look at the numbers. Overall, the company has a profit of $175.5. Let me make sure that was the printer division, has a profit of $61.5. The computer division, $136,250. But the copier division has a loss here of $22,250. So your question is, should I eliminate this segment of the business? Should I quit making copiers? Because I'm losing, $22,250. So if I get rid of the copier division, will that mean that my profit will go up $22,250? If I eliminate this loss, will this number over here for the total company be higher? You think, well, it looks like we should eliminate it. We're losing money. Again, this is a decision where you need to think about what revenues and what costs are relevant with this decision. To eliminate this segment, what are the relevant revenues and relevant costs? They're leading us through the decision process again. Step 1, relevant revenue. Well, if you get rid of the printer division, the copier division, you will not have, I should say this way, you will not have revenue of $550,000. So that is a relevant revenue item. What about the cost? Well, if you don't make copiers, you'll be able to save the unit level cost, batch level, product level. You're getting rid of the entire segment, and so you'll be able to eliminate the segment level facility cost. So those are what's relevant. So let me go back up again. If you get rid of this division, let me go back up so you'll see everything. This division, you will not have these unit costs. You will not have the batch level cost. You will not need the product level cost for the copiers. And for this segment, you'll be able to get rid of these costs. I'm going to come back to these in just a minute, so keep this in mind. But from here up are the relevant costs. These will still be incurred. We'll talk about that in a minute. So let's put this down where we can put it all together. Here is the projected, or in other words, differential revenue, $550. Here are the differential cost, unit, batch, product, and the facility level segment cost only. So take away all these costs from the initial revenue of the $550, and we have a projected income of $62,000. So when you just look at the relevant revenues versus the relevant cost, then you can sort of say, in other words, the copier division is paying for itself. It's taking its relevant revenues it's earning in that segment only and covering all of, in other words, paying for all of its segment-related cost. Segment-related facility cost, product level, batch level, and unit level. And we have $62,000. Now what this means is if we get rid of the copier segment the division of the company, we will in fact lose $62,000. So think about that a second. Here this says we will lose $62,000. It's paying for itself. We have a profit. Up here, it looked like we were losing money. That's because, I'm coming back to this now, you're going to incur all these costs whether this segment is here or not. So these are not relevant costs to this decision. This is not money going out the door because you have the copier segment of the business. You're going to incur these because you have a business in general. And if you don't allocate those, any of this number to the copier segment, these have to be divided up between the computer and the printer division. Okay, so instead of losing $225,250. Let me put it this way. Instead of saving $225,250, if you got rid of the division, you would in fact lose $62,000. Well, I can't picture this. Let's do it this way. Let's take out the segment of copiers and look and see what you have. Only computers and printers. Your income, of course, is lower. You have the unit cost, batch cost, product level cost of computers and printers. You have the segment level cost of those two. And now the allocated corporate level facility cost. These have gone up under both these segments now because you don't have the copier segment to spread this out over anymore. So you see the 123.2, 76.3, 93. Let's go back up. There they are, same numbers. So even though everything else changed, your revenue, all of these costs, relevant costs changed, these are not relevant. The 123, 76, and 93 are down here. So you still have those in total. So now look, your projected income, if you get rid of the copier, is $113,500. What was it when you had the copier division? It was $175,500. So it dropped a lot. It dropped that $62,000. From $175,500 down to $113,500. Sorry for all the scrolling, but that's just what I have to do. So what you're doing here, again, when you have a decision, whether it's outsourcing or special order or getting rid of a segment, once you go to make that decision, make sure you're looking at the revenues and the cost that will differ between the decisions. Okay, you're looking for differential revenue, differential cost, and that's the same thing as saying relevant revenue and relevant cost. That will help you make the best decision for your company. Now let's consider replacing some equipment. Let's look and see what we have. We have an old machine that originally cost $90,000. We've taken $33,000 in accumulated depreciation. The book value is $57,000. The market value now, if we sold it today, is $14,000. If we keep it and use it 5 more years, we could sell it for $2,000. The annual depreciation expense is $11,000 going forward. Operating expenses, $9,000 per year, 5 years, $45,000. The new machine, on the other hand, will cost $29,000. We could sell it for $4,000 in 5 years if we keep it and use it and then sell it in 5 years. Operating expenses, only $4,500 per year, 5 years, $22,500. So, should we keep the old machine or should we sell it and buy the new machine? Let's see what we need to consider. First of all, what are the relevant costs? Now, the old machine cost us $90,000. The current book value is $57,000, accumulated depreciation $33,000, annual depreciation expense going forward $11,000. None of those costs make a difference in a future decision. They are all irrelevant. They are sunk costs because they are past costs. They are based on past numbers. We cannot go back and change those numbers. Those numbers will not change going forward. All these costs then, I'll bump it up a little bit right here. All these numbers here and this one are irrelevant. They do not make a difference in this decision. Now, if we can sell the old machine for $14,000, that's the market value, yes, that makes a difference. That is relevant. Scroll down a little bit here. If we keep the old machine and use it for 5 years and sell it for $2,000, that's relevant. So when we take this into consideration, the opportunity cost of using the old machine nets out to $12,000. Why? We could sell it for $14,000 today, or we could keep it and use it and sell it for $2,000 later on. So $12,000 is the net opportunity cost if we keep it. $12,000. It is relevant. The operating expenses, it's relevant because they differ between alternatives. So $9,000 times 5, $45,000. I say it's different between alternatives because look, to operate the old machine, $9,000 per year. New machine, only $4,500 per year. That differs. That's relevant. So the relevant items here for the old machine, we need to consider the current market value, salvage value in 5 years, and then the operating expenses. Those are the relevant bits of information we need. For the new machine, the cost of the new machine, it represents a future economic sacrifice. In other words, it's going to cost us cash to buy it. That's a relevant cost. The salvage value, $4,000, that's relevant. If we keep it and sell it in 5 years, that's relevant. So the net cost of this is $25,000. We pay $29,000 today. We'll get $4,000 back in 5 years. The net cost is $25,000. Operating expenses will cost us $4,500 per year. 5 years, $22,500. So, with all this, should we keep the old machine or buy the new machine? What will it cost us? To keep the old machine, here is the cost. We have opportunity cost. This nets out to $12,000. Operating cost, we will incur $57,000. The new machine costs $29,000. Really nets out to $25,000 since we can sell it in 5 years. Operating cost $22,000. So only $47,500 is the cost. It is the relevant cost if we buy the new machine. So looking at the differences here, we should buy the new machine, and then we would save. Then we would save $9,500 if we buy the new machine. Okay. So the thing here is to again identify the relevant cost. Past cost, accumulated depreciation based on the past cost. Book value is based on past costs. Depreciation expense going forward is based on past cost. None of those numbers are relevant. Current market value, what we can get out of it in 5 years, and operating expenses going forward, those are all relevant. The new machine, its cost is relevant because we haven't paid for it yet. If we buy the new machine, we have to pay $29,000. As opposed to here, we've already paid $90,000. This is irrelevant. This is relevant. Salvage value, relevant. Operating cost, relevant. So we should then buy the new machine. Okay, let's go to the next page. Don't worry about this here, and probably towards the end of the chapter, yes. So again, go back and reread the chapter in detail, follow all the examples through, all the numbers, and good luck with your studies.